Well, great. Thanks, Kyle, and thanks everyone. I appreciate you taking the time to listen in to this session. We're coming live from Toronto, and I wish we could be there in person. I wanted to spend time today kind of peeling back the asset class of global smallers a little bit, and also talk about how we've done our best to try to, deviate from what I'll call the sameness. There's a lot of sameness in this industry. Everyone sounds the same. Everyone's looking for the same thing, and yet the returns, the deviation of returns over time are quite significant. So the way we think about that here at Langdon is that, in order to earn outsized returns, you need to be doing non-obvious things. And having done smallers for 15 years and global smallers for over 10, I don't know if I'm sad or happy that, global smallers are still non-obvious in the eyes of most allocators. I think it's presented fantastic opportunities for us and our clients over many years, and we think that the case is still there to continue doing that. The virtues of smaller companies that are timeless are not exactly the same as maybe the everyone else's interpretation, but for us, it's a very large and liquid addressable market. Liquid only to the extent that you don't try to raise too much money, which often is the issue among other firms or larger firms. And one of the other keys for us has always been the idiosyncratic growth drivers. We aren't relying on, GDP growth or interest rate contractions or stimulus in order to drive, we think really strong long-term returns. And that's never been more important than this very moment where we're realizing, I think a lot of industries are seeing big headwinds and big slowdowns, and there's not a lot that individual companies can do to uncorrelate from those sorts of situations. The other point that I think is quite important is the fact that a lot of these companies have a very high domestic focus, which again, until very recently was deemed a negative. But a lot of these smaller companies are what we call local champions, or the dominant player in a smaller market, and that's what allows for the resilient characteristics of the business while still remaining small. And then I think the last, real virtue here and why we felt like this was the optimal asset class to build a business around here at Langdon was the fact that there's very high dispersion of returns. This one's, it kind of cuts both ways. On one hand, it can be uncomfortable at times for end clients, but the flip side is without high dispersion, there's no opportunity to create long-term outperformance. So, which is what we're all in it for. We see that high dispersion of returns as a great ingredient to being able to deliver really strong long-term returns. And so, despite these timeless virtues, most allocators do not have a permanent allocation to global smalls. Having launched this strategy over 10 years ago, the thinking at the time was, at some point as the global equity asset class matures, there'll be, global smallers will be a dedicated allocation within global equities. And I know I'm 11 years older than I was then, and I don't know if this has changed tremendously. I think a typical client portfolio today looks like the pyramid on the right. You've got 3 to 5 managers within global equities hunting the same 500-600 companies, slightly different styles, perhaps. Some are more quality or growth or value, or and then you've got somewhere between 0 and 1 managers, originating opportunity within the 85% of the developed world, in the listed developed world, which is what we define as, under 10 billion. So that doesn't make sense to us, and we think that it over time should probably go the other way. If you've got 2 managers hunting global large and 2 or 3 hunting global small, that would make a lot of sense. But it might take a long time. So Langdon, we're a specialist dedicated small cap firm. We've got a 10+ year track record in global smallers. Obviously, we've been in the Aussie market for actually close to 7 years now. Previously, we're offered there under at my old firm, but in our current generation for 3 years. And to us, a small cap is 500 million to $500 million. This is the team that's originating all those ideas. We're oriented regionally. We spend a lot of time on ground in person, somewhere in the order of 50 to 100 days per person per year. And that's where we think the businesses are best understood, and also where the relationships are best cultivated. We only invest in 4 sectors. You can see here: consumer, financials, industrials, and technology. And again, up until recently, that might not have been conventional wisdom, but when you think about trying to immunize a portfolio from interest rates, geopolitics, uh, commodities, currencies, things that are outside the control of even the world's smartest and best capital allocators, these are the sectors where we think you can be best insulated from those issues. And so our, I guess, investment religion, you could call it, is very much rooted in cash flow. We think that cash flow is what ultimately drives business value creation and what can be underwritten when evaluating a company. And so, we tend to partner with companies that are run by competent and aligned long-term management teams. They have to be generating strong cash flow. And then one of the nuances here that I always like to point out is people think high returns on invested capital are good. We think they can be good. We also think that they can increase the likelihood of government intervention or increase competition. They can also sometimes frustrate end customers if your focus is on generating high returns. And then also, I think the biggest reason that we sometimes worry is it can often indicate that you're not investing sufficiently for future growth. And so we much prefer stable and improving returns on invested capital. And those companies typically have low debt or no debt. And then obviously, again, often misunderstood or neglected, but they have to be cheap. You can't just find a business with wonderful attributes and think that it will make for a great investment. You have to figure out what the right price is and then be very patient. So internally, we refer to these as "and" companies. We're trying to buy companies that can buy back stock and make acquisitions, grow organically, and pay a dividend. And we think largely these companies are what we call self-funded. They're not relying on capital markets for growth. And we think that the stock market at the end of the day it's pretty good at underwriting or pricing income statements, earnings, but it's less good at turning those accounting profits into cash flow and understanding the necessary adjustments that should be made there. And it's also not very good at underwriting management teams and their track records. They can get way too enthused and then completely unenthused with management teams at the wrong time, and that presents a lot of opportunity. So this optionality for us is core to what we think we've been able to deliver over time. And really, we try to break it down into 4 core differentiators. Everyone says they're people first, and then they'll tell you that they screen on PE or ROE or growth rates of revenue or profits. And I'm not 100% sure, but I don't think there's any sort of people dynamic going on there. So for us, we think the people first approach starts at the screening stage. We meet a lot of companies. We have a largely qualitative screen. And over the last 10 years, we've met over 3,000 companies in person and spent time with each of them. So we're trying to meet the entire universe every 6 or 7 years, and we'll get more into that in a minute. The other key for us is a deep focus on in-house origination. We don't go to conferences. We're not looking for recommendations from brokers or top picks or trying to find the next company that's going to get upgraded at XYZ broker. All this stuff is originated in-house and largely driven by bespoke travel, trade shows instead of conferences, things like that. Total alignment, I think, is another key for us. So we own 67.5% of the firm. We also have over $15 million of our own money invested in the portfolio. And the trading policy at Langdon is that there is no trading outside of the strategies that we offer our clients. So it's really the only wealth creation tool for people that work here, and we think that makes total sense. And then the last piece we'll touch on later is observable value creation. There's no sort of, this industry there's lots of gray day to day, but observable value creation is very black and white. If it's a wealth creating company and the stock chart's been flat for 15 years, got to ask yourself, like, how long is long? How long term is long term? So we'll get into sort of how we look at observing value creation. So here's a bit of a summary on what we think in-house global origination looks like. close to 300 meetings last year, or 300 different companies, 400 meetings, all over the world. We only invest in 23 countries. We were in half of them, more than half of them last year, and a lot of time spent building relationships in local context. So this is us. This is what observable value creation means to us. There's really only 4 ways a company can create value: through growing its revenues, improving its margins, having an expanding multiple, or taking on leverage. And this is sort of how a private equity buyout firm would look at the ways in which they can create value. If you look to the far right, that leverage column, we can't address that as a listed public company investor, so we don't. But we do target a 2x unlevered return over a 5-year period. So again, very similar to what private equity buyout would be looking for. But the key difference here is we don't underwrite multiple expansion in our investment cases. So the entirety of that 2x unlevered return needs to come from revenue growth and operating margins. And so we have this sort of framework that we apply historically to all the companies we're looking at to make sure that we can assess how value was created historically. And then on a go-forward basis, when we're underwriting what the investment case is, we're also kind of partitioning it into these segments to understand where is the value going to come from over time and how much of it is in the control of the business. And so, wrapping up, this is what I think is a very obvious checklist. I think every manager you meet that's doing bottom-up work would have something similar. Looking for compounders, again, very obvious. So what is the non-obvious thing about this checklist? To us, the non-obvious thing is that you need to have a belief about the business that is not widely believed by others. Or thinking about that in a slightly different way is the market's has to disagree with us about one of these 7 factors. And if they don't, then we might not be staring at a great investment. And so it could be subtle things, like we think the persistence of cash conversion being high is longer than the market expects. Could be that the debt to EBITDA of the business is high today because they just did an acquisition, but when you run out 18 months of free cash flow, they're actually able to delever back to net cash or maybe 1 turn of debt. And so there's optionality in the balance sheet. But rest assured, we're not making investments just because this checklist is met. We're only making investments in businesses where this checklist is met and we have a variant perception about the business. And there's nothing less obvious today than our geographic positioning. So I'll maybe just end on this. We don't look like a typical global fund where they've got 60 or 70% in the US, maybe another 10% in Canada, meaning they're 70+% North America. We've delivered, we think, really strong returns, actually better than large cap returns over the last 3 years, and have done it largely with overweights to the Europe, UK, and financials. And so in a world where how you've earned a good return hasn't necessarily mattered the last number of years, we think going forward, the source of the return is going to be critical, because we actually think we could just be in a pretty meandering place for beta. Beta just delivered 15% for 15 years. It might do 5 for the next 15 years. And in that world, you have to be willing and able to look different and be right. And so with that, you can see from a return standpoint, not only have we looked different, but we think it's played out very favorably for our clients. And we continue to be finding some of the best opportunities in 10+ years in the current environment. We welcome all the uncertainty, whether it be tariff or economic, and we're thankful that we have such a large universe to be originating opportunities from. So thank you for your time and attention today, and hope you enjoyed that.